All right, everybody, we got another minute before we get started here. All right, let's go ahead and get started. First, thank you everybody for attending. This is our first town hall meeting, one of hopefully many down the road. But with it being our first, we're likely going to have some mix up. It's not going to be our best version of us. So if you have any constructive criticism, certainly let us know afterwards. We would love that, and we appreciate your patience. So we're very excited. Before I dive into it, first off, I want to also thank Diane, Dana, and Denise for helping putting this together. I know Jake and I are really at the forefront, but really those three make sure that the ship is going in the right direction and it doesn't fall apart. So they do a great job. Again, thank you for taking the time to attend. We're expecting this to last about 30 to 45 minutes. And we hope to provide, this is going to be recorded and we'll be sharing it out later as well. So we've been using the same retirement planning software for roughly 15 years. I had effectively, if it ain't broke, don't fix it mentality with that software. And then new guy, Jake McKinney came along. If you haven't met Jake, Jake's the other advisor here at the firm. He has a very strong tax background. Super excited to have him on the team to be able to help support and serve our clients. His strengths are definitely outside of mine, which is what we're looking for here at Clark Wealth Partners. But he introduced me to new software through a firm called RightCapital. And as soon as we went through the demo, I was hooked. It's so much better than what we've used in the past, and not only helps us better serve our clients, allows us to be more holistic, more thorough, but it also allows you to gain more organization and clarity on your overall picture. So we're going to dive right into it. All right. So you should be able to see my screen right now. Jake, if you wouldn't mind confirming that real quickly.
Yep, I see it.
All right, perfect. So this is the software. Again, it's called RightCapital. With any software, what's most important is data. It's garbage in, garbage out, right? So one of the benefits of this software is to be able to reduce the probability that the information that clients give us about their situation is inaccurate. And I'll talk more about that here in a little bit. So we put together this sample individual. So it's Bill and Becky sample. We're not very unique here with our thought process. Bill and Becky sample. So Bill is 63 years old. Becky is 64. They have two children, Susan and Tom. And then they also have 4 grandchildren. So if we dive into their income, Bill's still working. Bill makes about $250,000 a year. Notice that in this section, this is where we also input any pensions and Social Security. So we're recognizing that Becky has FERS as she worked for the government. That's $16,900 a year. Bill also has a FERS pension, and then Bill is retired military. So he also has a strong pension of about $41,000 a year. I don't want to go too deep into all of this, but please know that we can be very specific. For example, how much would Becky receive if Bill were to pass away? Does Bill's pension adjust for inflation? All that fun stuff are items that we're gathering from clients and inputting into the analysis. How much are they saving? So currently, Bill maxes out his 401k, and that's really all they're saving on an annual basis right now. What are their current expenses? So currently they live off of about $5,500 a month, plus other expenses that we'll go over here in a little bit, including auto loans, including their mortgage, including real estate taxes, all those things. We want those to be separated for obvious reasons. At some point, your car is going to be paid off. Hopefully, at some point, your mortgage is going to be paid off. We want to be as specific as we can. But this is a place from where the generic spending, food, entertainment, utilities, just everyday living, okay? Next, we're going to go into their net worth, okay? So this is an opportunity. Before I dive into this, goes over everything. This is where we input their bank accounts, credit cards, investment accounts, any stock plan. If they work for a public company, what kind of stock compensation they might receive, loans, any property that they own, insurance, and so forth. But this is really an opportunity for clients to gain clarity and organization in their situation because you can link all of your various accounts in those areas to RightCapital. Okay, and I'll show you exactly how. Click this link. Charles Schwab is already going to be linked for you. You're going to hit aggregate. And I'm just going to select Wells Fargo as it's one of the options, but you can run a search in here. Personally, I bank at Carrollton, so you can type in Carrollton and it will pop up as an option. Obviously, safety is always of big importance. What you'll see here is when I click on Wells Fargo, you'll see that it's asking me to continue by by sending me to Wells Fargo site. Okay, so now a separate screen is propped up, which admittedly you may or may not be able to see right now, but this is an opportunity for me to input or for you to input your user ID and password. Note that you're not actually inputting it in RightCapital. So RightCapital is never storing your user ID or password because you're never inputting it there. And that's a very important thing for safety measures. So again, you can go into and click connect all your accounts to help you gain clarity and organization to your financial picture. It is important to note that you will not be able to create transactions. So you will not be able to pay bills, move money from one account to the next. The purpose of this software is strictly to give you organization and clarity. If you have the ability to move money, then quite frankly, that's just another site that has your information on that you could be hacked and bad people do bad things with your money. So I'm going to go over this example again of Bill and Becky sample. They have a savings and a checking account at Carrollton Bank. Here's their investments. Becky has a rollover IRA at Charles Schwab. She has a brokerage account at Charles Schwab. Bill has a 401k with his current employer, as well as a rollover IRA at Charles Schwab. This is where we're inputting how much Bill is. Oh, I'm sorry, we're not doing that. We're doing that somewhere else. So again, this is just showing an outline of their investable accounts. Next, we go into loans. So here's their primary mortgage. And I talked earlier about that kind of generic number of $5,500 a month for spending. This is where we're going to input the mortgage information. So we're showing that this mortgage started in 2010. It's a 30-year note. So it's going to go to 2040. So the system's going to recognize that expense going away. The monthly payment of principal and interest is $2,200. And we want that separated from homeowners insurance and real estate taxes, which I'll show here in a little bit, because unfortunately, those two things don't go away when our mortgage goes away. Same thing for the cars, right? We show that Bill has a 2024 Ford F-150 loan amount. We dive into the interest rate, monthly payment. We want to know when the loan started and therefore when it's going to be paid off, because again, we want to recognize that expense going away. Property. So their primary home is estimated to be worth $650,000. Unfortunately, of course, when we're talking about a value of a home, it has to be manually inputted. That's not something that can be automated. We're inputting the property taxes. We're recognizing their homeowners insurance. And then, of course, we're recognizing annual maintenance. Unfortunately, lately, we might want to increase this by more than 3% if you're anything like me. But for right now, we're leaving their tax increases at 3% per year, which mimics the annual appreciation of their home. Also have an opportunity for insurance now with Bill being 63. For this sample, we're not focusing on life insurance because that's not going to be one of the planning opportunities that we can help with. And that was really our objective for this for today, this town hall meeting. Here we're inputting the value of the vehicles as well. Okay, so you see Bill and Becky have a total net worth of 3.1 million and change. So very good savers over their lifetime. Next, we're going to dive into goals. So a lot of you might recognize this looks very similar to the previous software we use, but it's much more user-friendly and more thorough. So Bill wants to retire at 65. Becky is already retired. They want to live off of basic income of $5,500 a month, plus the mortgage and other things that we discussed, and because they want to continue the lifestyle that they currently have. For healthcare insurance, just like the previous software, the system uses national averages. So all of that is inputted in here for Medicare Part B, D, and so forth. The system does use the adjusted gross income that is inputted in the system based off of the income that we have inputted or the client has inputted. This client wants an annual vacation goal of $20,000 a year for the first 15 years. Their assumption is that after the age of 80, they're probably not going to do much traveling. Bill and Becky are very giving with their money. They have historically given $20,000 to charity, and they want to continue that. So we want to recognize that them doing this every year throughout the rest of their life. Home improvement. Most of us are homeowners. We don't know when something bad's going to happen. We don't know what it's going to be. And we don't know the dollar amount, but we know there's going to be some things that happen to the house that are going to be pretty darn costly. So we want to recognize that in the plan. So we have two $40,000 home improvements, one randomly in 2035, and then another one 10 years later. We also discussed with Bill and Becky their cadence with cars. Some people drive cars until the wheels fall off, as we say. Others like a new vehicle every couple years. So we want to have an honest conversation with clients about what their style is with vehicles and make sure that we're honest about that going forward. If a client is used to getting a new vehicle every 3 years, and now they all of a sudden believe that they're just going to want a new car every 10 or 15 years, you're not likely being honest with yourself. So obviously with the plan, we want to make it as honest and real as we possibly can. So for Bill and for Becky, they do keep them pretty long pace. So every 8 years. So during retirement, we have them buying a total of new cars, as 2 new cars, as both of their cars are pretty darn new right now, 2022 and 2024. So there's their goals. Feel like it's pretty thorough, but it gives us the opportunity to input many other goals. Education. Are we wanting to save for kids' college? Vacations, wedding. Are you wanting to buy a second house? Are you wanting to buy investment property? Maybe you're wanting to start a new business. Not many people do that when they're retired, but again, we have a ton of options for inputting goals that you might have. Let's see here. So now what we're going to focus today, you notice up top, it's showing investment, retirement, insurance, education, tax, and estate. We're not going to go over estate, insurance, and education or estate planning because, well, first off, a couple of them aren't really relevant to Bill and Becky. But secondly, we want to make this somewhat of a short video here. But before I dive into the retirement plan, I want to show you the dashboard. So this is what you would look at when you log into your RightCapital online. It is a snapshot of your entire picture. It shows the probability of success of you achieving your financial goals, your current net worth, your effective tax rate, a quick and dirty of your balance sheet. And again, if you connect your all of your investment accounts, those are going to be updated once every business day to give you that updated valuation of again, your assets and your liabilities, whether it be your credit cards, your mortgage, home equity lines of credit, any other debt you might have, and then of course, all of your assets. It also shows you an asset simulation of what your assets are likely going to look like. Is this based off of a hypothetical rate of return? Yes. That is relevant to your risk tolerance, which we know. But the key thing we want everybody to recognize is that it's really based off of you achieving your goals. So it's based off of you pulling money from it. We're not saying if you never touch it, this is what your assets are going to look like. This is based off of you living the life that you've stated that you want to live. And the darker the color, the higher the probability that that's what happens. Okay, so this runs what's called Monte Carlo simulation, which runs 1,000 scenarios of what the market might do in the future based on what the market has done in the past. Hopefully that makes sense. It also shows you an outline of your current allocation. Again, not just here with us at Charles Schwab, but looks at assets that you have everywhere to give you an easy way of looking at what your risk, the allocation of your portfolio looks like, and in turn, the risk that it's taking. Tax allocation. This particular client doesn't have any Roth IRA money, but it shows how much of your money is tax deferred versus how much is taxable. There's also an opportunity for us or you to input notes. Maybe it's a reminder. Maybe last time we met, you talked about how you'd like to put together an estate plan, but you keep putting it off. Maybe we put a friendly reminder on there for you. One other thing I want to show you before we dive into the retirement plan itself is this. We call it a vault, RightCapital calls it a vault, but really it's a folder. And there's a shared folder which we can see and view, as well as you, of course. And then there's a private folder. And what I do for my wife and I's RightCapital is we save our estate plan documents, our trust, our will, our healthcare directive. All of that is saved in my RightCapital. My most recent tax return is saved. Our passports are saved in case we're in the Dominican Republic and I misplaced my passport somewhere. At least I have a visual of it. Life insurance documents are saved. The reality is there's some very important, vital documents that we typically get, and then we store it somewhere and we forget where we store it. And then when we need it like this. So the idea is that you can have that on your phone in a safe manner in case it's needed by either you or your loved ones. One thing I want to go back to, and I failed to recognize, is one point of frustration we hear from a lot of clients is, Bill, when he logs into Schwab, he sees his assets, but he does not see Becky's assets, right? Well, both Bill and Becky, you and your spouse, if you have one, will each receive your own user ID and password. And what each of you connect to RightCapital, the other person will be able to see. That's good. We certainly can think of some scenarios where that's not preferred, so be cognizant of that. But I think anytime you can gain clarity on your household financial situation, that's always better. All right, now we're going to dive. Oh, yeah, Jake.
Really quick before you leave the profile section, will you go back to the goals section really quick?
Of course.
We had a question come in asking if you could override the Medicare numbers. So if you just simply, yeah.
So right in here, we can change it to whatever we want.
Perfect. Thanks.
Yeah. Great. All right, now we're going to dive into the retirement plan. And you've already seen that this person has 100% probability of success. Personally, I'm not a big fan of showing 100% because who knows where life takes us. But again, this is based on the data that we're looking at that we've inputted today. As always, we want to review this plan with clients every year, at least every 2 years, depends upon where they are in life. So here's their current plan. So this is what they were doing prior to meeting us. And then Jake and I put together some planning strategies that we commonly implement for clients, and that is shown on the proposed plan. So notice the probability of success is still at 100%, But notice the bucket of money at the end of the rainbow, as we say, is dramatically higher. It's almost doubled. So how did we get there? There's a couple ways. One is glide path. I'm sorry, the first one is Social Security. So just like before, we have the ability to run an analysis to see when you should take Social Security based purely off of the math. And all of you have probably heard me say this, we're human beings. We do not make decisions in life based purely off of math. Many of us have a bird in a hand as we're two in a bush mentality. But this really helps us provide the math. And by the way, for you men out there who always tell us, Mike, there's no way I'm going to live to 90 or whatever it is we have inputted, we can play around with that. We can show that if you pass away at 80, how would that change the decision of Social Security? So it's very easy to play around with this. You see how interactive this is, which is what we love. And before I dive into this retirement, one thing I want to make sure to note is that you have the ability to change the plan on your own. So if Bill goes into work, boss pisses him off, pardon my language, and he wants to change retirement to immediately, you can do that as a client on your own, and it will show the probability of success. Does that, it's going to change, but are you okay to do that or not? It does not change the master plan that we have on our end, and we think that that's a pretty cool benefit of this software. So Social Security, helping clients, helping this particular client and all of you determine when they should take Social Security and why. So it's showing that the best plan for them is that both of them file at 70. Okay, that's not always the recommendation, but for this particular couple, the recommendation is to file at 70. Okay, some other things that we're looking at. Excuse me. We are looking at tax strategy, and this is where Jake does all the heavy lifting. And when I say all, I literally mean all. So the software is amazing. We've done a lot of work behind the scenes in preparation of this town hall meeting. Jake spends hours on this for clients, optimizing it, and you'll see what I'm talking about here in a little bit. But what you'll see is the ability, there's three different areas where we can provide a lot of value in tax strategy. One is called asset location. And we've probably talked about that before, but the idea is that we want to put as much of the aggressive assets as we can in the most tax advantageous buckets, i.e. Roth IRA is the most tax advantageous. And then the most least tax advantageous are the rollover IRAs, 401ks, all the things where your contributions were deductible, and now you're going to have to pay the piper. Those are the accounts that we want to be invested in the most conservative manner so that the collection of all of the assets adhere to clients' risk tolerance. And by doing that, Jake can show how we save you a tremendous amount of money over your lifetime, in particular taxes being paid, right? Because we recognize that stocks are going to outperform bonds over the long run if history repeats itself. So to simplify it, we want as much of the stocks and the Roth IRAs and taxable accounts as we can, and as much of the bonds and CDs and treasuries and all of those more conservative things that are really meant to smooth out the ride of the entire assets. We want those in rollover IRAs, 401ks, things of that nature. So that's one of the strategies. The next one is the withdrawal sequence. It's very, very common for clients want to delay taking money from their rollover IRA and 401k as long as they can. Why? Because it's taxable, right? If you withdraw $1,000 from your rollover IRA, that $1,000 is 100% taxable. Roth IRA, on the other hand, is 100% tax-free. Obviously, for taxable accounts, it depends, if we sell Johnson & Johnson at $1,000 and the cost basis is $800, you're only paying taxes on the $200 and at a most likely a 15% tax rate. But while a lot of clients want to defer that pain by delaying taking money from the rollover IRAs as long as they can, What they're not recognizing is they're really increasing their lifetime tax obligations tremendously. And that's one thing what we're trying to do here is we're not really focused on minimizing your taxes today. Our focus is on minimizing your taxes over your lifetime. And the old saying, short-term pain for long-term gain, is a saying for many things, including investment management. So the typical withdrawal strategy that we recommend is we're going to take money from taxable accounts first, tax deferred, and then most definitely tax free last. But taxable and tax deferred, it really depends on the situation for the client. But no matter what, we're taking it from Roth IRA first. The other thing is Jake ran a partial Roth conversion strategy, and he plays around with it to see where the sweet spot is. And what we mean by that is that it is, let's see here. Here we go. What's common is if you retire or when you retire, there's typically a sweet spot from the time that you retire until you have what's called required minimum distributions. And that, as you know, is now age 73. In roughly 2033, it's going to go up to age 75. But that's when the government says, hey, we don't care if you need the money or not. We're going to force you to take a minimum amount from that account every year for the rest of your life. Well, that's a sweet spot where you're likely going to be in the lowest tax bracket you've ever been and will ever be, that Jake plays around with converting a portion of your IRA over into a Roth to maximize certain tax brackets. And for this particular strategy, we're maximizing the 22 and 25% tax bracket. These three strategies alone, withdrawal sequence, asset location, and the partial Roth conversion strategy for this particular client, it's estimated it's going to yield them an additional $2.8 million over your lifetime. I know that sounds like a lot, but it's real. We've looked at it, and it's just a great opportunity for clients. All right, Jake, anything to add to that?
No, I think you covered everything.
Okay, perfect. A couple of the things that we implemented for strategies for the client is backdoor Roth IRA contributions. That's something that they were not taking advantage of. You saw their income, so they're not eligible for it with the combination of her pension as well as his salary at work. The other thing is that they were giving in a fairly generic way. They were just writing $20,000 worth of checks throughout the year to their church and various charities. So we talked to this person about a donor advised fund, and with the amount that they had in their taxable account, we inputted into the system is we said that we wanted to fund the donor advised fund, not from cash, but by choosing their most highly appreciated securities and their taxable account so that they can forego that future tax liability. On top of that, we wanted to recognize when they do begin taking money from their IRAs at the age of 75, that's going to be his age when Bill turns 75, his required minimum distribution, is we want to make sure that they're recognizing qualified charitable distributions. And just a fresh refresher on that. Once we turn 70 and a half, and I know it's confusing because that was the RMD age, it's no longer that age at 73. But once we turn 70 and a half, you have the ability to write checks directly from your rollover IRAs to a qualified charity, and that distribution is tax-free, and it goes towards satisfying your required minimum distribution. So for example, if your required minimum distribution is $20,000, if you make the check payable to you, and then out of your checking account at the local bank, you write the checks there, well, that $20,000 is taxable. But if instead you take the checkbook that we provided you from Charles Schwab that is specific to your rollover IRA, and you write the checks directly to the charities from that account, Now that $20,000 in collected distributions over the year is 100% tax-free. So there's really no reason for anyone who's of the age of required minimum distributions to not be taking advantage of that. Okay. So now that we've added more money to their pile, we could do one of two things. We can either talk to them about how they can maximize gifting that to their family throughout the year, and that's a little complicated, so I'm not going to go over that today. Or a more exciting conversation that we have here, and all of you know that we love to stress the importance of balance and living life, is, hey, you're already on track to achieve your goals. We did some things to dramatically increase the efficiency of your money, right? No more money out of your pocket. We're just making it more efficient. Instead of adding more money to the end of the rainbow for your kids and grandkids, let's have you live a little bit of a more exciting life. So we're going to have Bill retire immediately. We're going to increase their monthly budget, for lack of better terms, by $2,500 a month to $8,000. And we're going to double their travel budget. So if you're playing along $2,500 a month, 12 months, that is $30,000. We just added $20,000 to their vacation goal. So that's a collective $50,000 of expenses that we just showed them that they can do. And notice that the money at the end of the rainbow, when Bill dies on his 91st birthday and Becky on her 94th, is almost the same as it was when they started with us. And that's because we've implemented some strategies to, again, maximize their money, create some efficiencies, reduce taxes over their lifetime, and that's allowed them to live a fuller life. What they do with that $2,500 is obviously up to them. Same thing with the collective 50, including travel, but it's pretty exciting to look at clients in the eye and to show them that they can expand their goals a little bit. It makes some clients nervous at first, but it's pretty exciting for us as well. So again, we're very excited about this software. Didn't really go into it, but I'll just quickly show you. This person is likely going to have some estate taxes. So there's some things that we can do with gifting their kids and grandkids $18,000 per year down the road to really minimize this. So we can get, education planning. We can choose a particular college. My son, for example, he's looking at Illinois State University. I can implement Illinois State University. It knows the average tuition. We can do all of that. Same thing on the insurance side. But for most of our clients, the bulk of how we're helping them is really with retirement planning and overall tax planning. So we're just past the 30-minute mark. We're very excited about this software. Again, if you have any questions, please reach out to us. We'll reach out to you and answer them. And looking forward to go over this plan with everyone, hopefully in the next month or so. Jake, anything that I miss?
No, we did have one more question come in.
Yeah, what question we have?
It says, when I configured my portal, it appeared that Schwab accounts that were initially set up were not linked to automatically update. So they then went and linked new accounts through Schwab. How can they delete the old accounts that aren't automatically updating?
Yeah, so Jake is really our RightCapital expert on this. But Jake knows that we'll be able to delete them on our end. We'll be able to delete one of them so that it's not doubling up.
Yep.
So, well, very good. We appreciate your time. If you have any other questions, let us know, and we hope you enjoy the rest of your week. Thank you.